Have you always wanted to make money while you sleep? Well, you can, and there are a lot of options out there. So today I'm breaking down the pros and cons of two: CDs and dividend stocks. Let's get into it. CDs, or certificates of deposits, are relatively easy to set up at a bank or credit union, and there are lots of options to meet your needs. Some pros: one, safety. CDs are like the Fort Knox of investments. They're typically insured by the government up to a certain limit, so they're incredibly safe. Two, predictable returns. With a fixed interest rate for a set period, you know what you will get at the maturity date. No guesswork on how much interest you will earn. Three, liquidity, or how easy it is to get your money out. Need cash before your maturity date? No problem, but expect some fees. Much easier to get your money out of a CD than something like, say, a real estate investment. Some cons of CDs. One, low returns. Unfortunately, CDs are not known for their wealth growing potential. Interest rates are generally lower than other investments like stocks or real estate. Two, lack of flexibility. Once you commit to a CD, you're in it for the long haul. There's no hopping off early unless you're willing to pay the price. You have to pay the fees if you want to get your money out early. Three, inflation risk. Fixed returns might not keep up with inflation, eroding your purchasing power. If your CD is paying out 3% but inflation is 7%, while your money is locked up in the CD, you are actually losing purchasing power. Let's switch gears and talk about dividend stocks. These are stocks that you can buy through a brokerage like Fidelity, and some of the profits are paid out to shareholders like you in the form of dividends. Some pros of dividend stocks. One, higher potential return. If you're looking for growth, dividend stocks have the potential for much higher returns compared to CDs. Two, ownership stake. When you invest in dividend stocks, you are a partial owner of the company. This comes with voting rights and benefiting from potential growth. Three, flexibility. Unlike CDs, you can trade your stocks during normal business hours, giving you more control and liquidity. You can take your money out at any time. But there are some cons to dividend stocks. One, volatility. The stock market goes up and down, and this can feel scary, especially if you have short-term goals and you are checking on your progress often. Your investment's value can fluctuate significantly. Two, risk of loss. Unlike CDs, there is no guarantee of returns. If the stock market value tanks, you could end up losing money. Three, research and monitoring. Owning individual stocks requires some research and monitoring. Totally something you can do, but this takes some amount of time to set up. So what's going to be the right choice for you? CDs offer safety and predictability, but they're not going to help you get rich quickly. On the other hand, dividend stocks provide the potential for higher returns, but come with more substantial risks. Let me know in the comments, which one would you choose? If you want to learn about what really keeps couples back from getting out of debt and reaching financial freedom, I am giving a free masterclass, and the link to register is in the description. If you found this information helpful, like this video, subscribe, and ring that notification bell so that you don't miss out on any financial insights.